Brad Thomas here with the Intelligent REIT Investor. I'm joined today with Scott Peters, the CEO of Healthcare Trust of America, ticker symbol HTA. Scott, good to see you today.
Good to see you. Thank you for coming.
You bet. Scott, last week I was at the doctor, took my kids to get their back to school checkups. So it looks like the supply and demand is pretty strong in my house in terms of visiting the doctor's office. But let's talk macro and what your company does. Obviously you own medical office buildings across the country, but let's talk about the supply and demand today.
Well, we think the supply is great, and I'm glad your family's going and getting checked up on a regular basis. What we're seeing with the Affordable Care Act is we're seeing, the physicians are seeing continued use as you would expect. One of the changes that we have seen is that the physician groups are combining themselves. So I don't know if you went to a sole practitioner, but we've seen sole practitioners now actually being reduced across the country. Our typical tenants are larger physician groups or healthcare systems where you go to a Mayo Clinic or you go to a Scottsdale Healthcare here in Phoenix and you see their doctors.
So Scott, in terms of your portfolio today, can you talk a little bit about where you're located geographically and who are your major tenants?
Well, we're in 27 states, and we really like the geographic locations of our major markets. We just recently bought a $142 million acquisition in Boston. Boston is now our largest investment by dollars. We're also in Pittsburgh. We're also in Greenville, South Carolina, near your neck of the woods. We're in Atlanta with almost 700,000 square feet. We've just moved into Florida. Over the last year, we've bought over $250 million in Florida. We like the Florida market. We like Miami. We like West Palm, where we recently bought an acquisition at the end of last year. Like the fact that the economy has rebounded down there. So if you look at the major markets, we like Raleigh because of the triangle. We have over $50 million invested in Raleigh. We like Phoenix. Phoenix has shown some improvement over the last 3 to 4 months. So we're trying to find good markets. And then our second most invested state is Texas. Texas, of course, has been growing, and one probably wouldn't leave it off its list if they said where are great markets, Houston, Dallas. We just bought some stuff in Austin, Texas. Texas University is there and is a big supplier of the infrastructure. So we're trying to follow locations that are really geographically going to grow over the next 10, 15 years. That's what physicians need. Physicians, healthcare systems need patients.
Great. Well, let's talk about growth, because I know this last quarter, second quarter, I think year to date, you've acquired around $200 million of assets. How hard is it to grow the portfolio today with the competition with the larger healthcare REITs and the other competitors? How hard is it to grow your portfolio?
We've bought $212 million year to date. We bought about $400 million last year, and the year before we bought close to $300 million. We are a targeted buyer of real estate. We like to buy assets $25 to $75 million in value. We like to know where we're buying it, how it's going to perform. Really say, we want same-store growth for our portfolio. We've had 7 quarters in a row now of greater than 3% same-store growth. MOBs, medical office buildings, they're really attractive investment. With the Affordable Care Act, with the fact that healthcare is changing, the greatest employment provider over the next 10 years is supposed to be healthcare. So that's even another tailwind that healthcare has. With liquidity, which is happening in the MOB space, comes opportunity. Now, we just have to continue to execute and use our relationships and find those acquisitions in our markets that we like. But we're very comfortable with our ability to grow our portfolio 10% a year.
Let's talk about how you turn those acquisitions into earnings, and what we call in REIT world funds from operations. How did you perform this second quarter in terms of your earnings growth?
Well, we increased our FFO, which is the term that Real Estate Investment Trust use, 12.5%. We grew our cash NOI, which I think is very important, by 3.1%, because every quarter over quarter you want to grow the net operating income coming from your buildings. We have our own asset management team. We have 90% of our properties managed in-house, both leasing and property management. It allows us to bring value to the tenant. We focus on cost savings from an expense savings perspective. So, we're 91 plus occupied. We had a 30 basis point increase this last quarter. So from an operational perspective, we're doing the right things and the sector's doing the right things to help us.
Scott, let's talk about your dividend. I know this last quarter you've announced albeit a 1% modest dividend.
Well, we did. You know, it was the first quarter that we raised our dividend, and we try to take a balanced approach. We think it's very important when we can find good assets to reinvest in. We use our free cash flow to reinvest. On the other hand, we still have a 4.8% dividend yield for investors. We've got a very conservative balance sheet. We're investment grade rated. We're a BBB flat from Standard & Poor's. So we look at the opportunity to continue to reward shareholders going forward with a dividend increase. But on the other hand, reinvest that free cash flow into great buildings that are going to produce income for shareholders over the next 15 or 20 years, not just on a quarter basis based on a dividend.
Scott, thanks so much for the update today in the second quarter, and we look forward to seeing you again this year.
Oh, thank you.
Thank you.